Okay, let's dive into this. Welcome to today's explainer. Look, whether you're just dipping your toes into investing or you've been around the block a few times, the noise out there is absolutely deafening. Literally every single day, millions of pieces of financial content get blasted across social media, with everyone shouting about the next big thing. It creates this crazy, chaotic echo chamber, and man, it is incredibly easy to get completely lost in it. So today, we're cutting straight through all that noise. We're going to lay out a structured, proven playbook. We're looking at the absolute best beginner investment strategy that you can actually start using today. And ironically, it's the exact same foundation used by some of the most wildly successful veteran investors in the world. If you're new to all this, or even if you just have a portfolio you haven't really looked at in a while, you're probably feeling that familiar, overwhelming confusion. I mean, you open any finance app, and what do you see? Stocks, crypto, real estate syndications, niche ETFs. You've got hundreds of different voices pushing totally conflicting narratives about where exactly you should put your hard-earned money. And hey, it is totally valid to feel overwhelmed by all this. Honestly, even seasoned investors constantly battle shiny object syndrome when new trends pop up. With so many complex choices competing for your attention, we really have to ask, what actually works when you're just starting out, or when you literally just want a reliable system? Well, most people make one massive mistake right out of the gate. They chase the hype. They buy whatever is trending right now. Maybe it's a hyped up tech stock, a meme coin, or some supposed guaranteed fast money play. And look, I get it, it's human nature to want fast profits. But the empirical data shows us time and time again that chasing fast money almost always leads to incredibly fast losses. Studies regularly show that the vast majority of retail day traders, we're talking upwards of 80 to 90%, end up losing money over the long haul. It's basically a guaranteed recipe for anxiety and blown savings. Now, contrast that with building wealth slowly. Successful investing is actually incredibly boring. And honestly, that is a fantastic thing. Embracing boredom is basically a financial superpower because boring, consistent, long-term decisions are exactly what build lasting, peaceful wealth without giving you daily heart palpitations.
Phase 1. Your financial defense shield.
So before we can go on the offensive and grow our money, we absolutely have to set up our defense. You just can't build a castle on quicksand. Imagine this for a second. You've just put all your extra savings into the market. You're feeling great about it, but suddenly, bam, a massive medical bill drops right in your lap. Or your car's transmission completely gives out on your way to work. Or worst case scenario, you're facing an unexpected job loss. These sudden expenses are just a harsh reality of life. If you don't have a financial protection layer built up before you start investing, you face what the pros call forced liquidation. That basically means you're forced to sell your investments to get cash at the absolute worst possible time, like right in the middle of a market crash, locking in massive losses just to cover your rent or pay the mechanic. The golden rule here, and I mean the very first step before you buy a single stock or asset, is to save 3 to 6 months of living expenses. That magic number represents your emergency fund. It kind of feels like a cruel joke of the universe that expensive emergencies only ever seem to happen the day after you've invested your last spare dollar, right? This fund just sits there, entirely untouched, guarding your life. It provides an unbelievable amount of psychological peace of mind. You're going to sleep so much better knowing it's there, and more importantly, it ensures your actual investments can do their job, totally uninterrupted by the chaos of daily life. Once that shield is safely locked in place, then, and only then, do we actually start investing. Phase 2, the core offensive strategy. Let's move to and see how this builds into an actual plan of attack. This is where the actual mechanics of investing come into play. The best strategy relies on 3 incredibly simple, time-tested pillars. First up, invest consistently. This means putting money in every single month, regardless of what the market is doing that day. In the finance world, this is called dollar cost averaging, and it completely removes the headache of trying to pick the absolute perfect day to buy. Second, focus on long-term growth. We really need to actively train our brains to think in decades, not just days or weeks. And third, choose strong assets. Notice that nowhere in these 3 steps does it say you need to perfectly predict the future or analyze complex corporate balance sheets. This entire framework is built on the reality that plain old discipline always wins out over supposed genius. Now, what's really interesting about this slide is how we define those strong assets. Index funds and exchange-traded funds, or ETFs, are the ultimate smart starting point. Why? Because instead of trying to pick one single winning stock, they automatically spread your risk across hundreds or even thousands of different companies all at once. Think of it like this. Instead of spending all your time frantically searching for the one golden needle in the haystack, an index fund lets you just buy the entire haystack. You don't have to rely on just one single company hitting it out of the park for you to make a solid return. If one company stumbles, the hundreds of others in the fund balance it out. This single choice makes the whole process infinitely simpler and drastically safer for anyone building a portfolio.
Phase 3. The compound interest engine.
And this brilliantly illustrates the real climax of the strategy. If there is a true secret weapon to investing, this is absolutely it. This is where the magic happens, and your money actually starts doing the heavy lifting for you. If you invest a seemingly small amount, let's say $200 every month consistently, it doesn't just grow in a straight, boring line, it grows exponentially. The money you invest makes money, and then that new money makes even more money. Over 10 or 20 years, that consistent monthly contribution snowballs into something truly massive. It's the mathematical beauty behind concepts like the Rule of 72, which tells you exactly how fast your money will double based on your rate of return. That initial heavy pushing turns into a totally unstoppable avalanche of wealth. This exponential math is exactly why starting early matters so incredibly much. Time is literally your absolute biggest advantage in the market. Let's look at a classic, powerful example of how this plays out. Imagine person A starts investing at age 25, puts in a set amount every month, and then completely stops investing at age 35. Person B waits until age 35 to even start and invests that exact same monthly amount all the way until they hit 65. Because of the sheer runway of time, person A still ends up with more money, even though they invested for 20 fewer years. Because the compound interest engine requires patience to work its magic, giving your money a long runway is infinitely more important than trying to scrape together a massive pile of cash to start with.
Phase 4. 3 mistakes to avoid.
To protect that newly built wealth as it compounds, we need to set up some psychological guardrails. So the crucial point is recognizing these behavioral pitfalls before you fall right into them. Number 1, panic selling. Look, markets go up and down. That is a completely normal, healthy part of the economic cycle. You cannot sell just because you see a drop in your portfolio value. That's just loss aversion playing tricks on your brain. Number 2, emotional investing. Letting fear and greed drive your decisions will absolutely destroy your portfolio. And number 3, trying to time the market. Listen to this. Over a 15-year period, nearly 90% of actively managed funds run by highly paid Wall Street professionals fail to beat the market. If the pros can't time it, we definitely shouldn't try either. Consistency beats prediction. Always. This entire playbook really boils down to this single, empowering reality. Wealth isn't built in one day. It's built through smart decisions repeated over time. You don't need to be a financial genius, a math prodigy, or some Wall Street insider to succeed at this. Save your emergency fund first. Invest consistently, regardless of whatever the news cycle is screaming about. Stay patient and think long-term. It really is just simple, repeatable discipline.
Which leaves us with the most important question of this entire explainer. Are you ready to start small but start now? The absolute best time to begin was yesterday, sure, but the second best time is today. The math is totally proven. The strategy is set. The only variable left in this equation is your discipline. Take that very first step toward your financial freedom, build that safety net, and just let time do the heavy lifting for you. Thanks for learning with me today, and I'll catch you on the next one.